Okay, well, I have to start today with the latest Canadian jobs report. Came out last Friday, and this will impact the Bank of Canada's next rate move. We closed out December with an unexpected jump in employment, and this now raises some pretty big questions about what's next for interest rates. The bottom line here is, will the bank hit pause on any further cuts? I want to break it down for you here. First of all, some facts. Canada's unemployment rate ticked down slightly in December. It came in at 6.7%. That's down from 6.8% in November. And the economy added a massive 91,000 jobs. That is almost quadruple the forecast of 25,000, the largest gain now in nearly 2 years. And really importantly here, this wasn't just part-time work. 56,000 of those jobs were full-time. Another thing I noted was that the gains were broad-based across a lot of different industries: transportation, healthcare, education, pretty much across the board. And even better, the total hours worked rose by 0.5% month over month. And that's actually a sign of some real economic activity. There is a kicker here, though. Wage growth actually slowed to 3.8%. That's down from 4.1% in November. And that's actually good news for inflation, but then you have to wonder what it means for rate cuts. I'm going to talk about that more in just a moment here. Meanwhile, the participation rate stayed at 65.1%, and that's holding steady at its highest level in 4 months. So you have to ask, what is driving these numbers? Well, some of these gains came from unique circumstances like the return of the previously locked out port workers. There was also a big chunk of hiring in the public sector, which made up nearly half of December's job gains. As far as private sector growth, it is slower, and that could be a sign of caution amongst businesses, which isn't a great thing, especially because we've seen such a big chunk of monetary easing throughout 2024. The goal there is to stimulate hiring. So what is the impact here on the policy, on markets, on businesses? Well, no question that this report is a bit of a curveball for the Bank of Canada. When we headed into 2025, the bank had already signaled that it would be slowing the pace of rate cuts after it was so aggressive in lowering that overnight rate to 3.25% in Q4. The current rate, it is right at that upper edge of the band of what they consider to be neutral. So after this strong jobs report, the markets have really started to trim expectations for a January rate cut. Before the data came out, there was a 70% chance of a 25 basis point cut. Now, that seems to be closer to about 50-50. So you've got to ask, why is the hesitation? Well, when you look at this job report, the strong growth, it suggests that the economy might not need as much stimulus as they originally had planned. Plus, with the U.S. bond yields rising sharply and then the Canadian dollar under so much pressure, any further cuts to the rate could risk weakening the loonie. That would obviously stoke inflation for imported goods as well. Another thing I noted to watch here is the looming threat of these U.S. tariffs. If these do materialize, Canadian exports and jobs could take a hit. The Bank of Canada also needs to consider how global bond markets are tightening financial conditions, even as the U.S. Federal Reserve Board is kind of getting closer to possibly pausing rate cuts there. So where does this leave us as Canadian investors? Well, I don't want to sound like a broken record here, but I'm going to take that risk right now because the Bank of Canada is really facing this delicate balancing act. On one hand, the strong labor market, it does suggest that a pause on rates would be warranted, but then you flip to the other side, and the broader economy is still struggling with this elevated employment when you compare it to last year. Even though we did come down a little bit here, businesses seem to be cautioned, and then we still have a lot of global uncertainty out there. If the bank does cut rates this month, I think that it'll probably be the last one for at least a little while. Curious, what do you think? Should the Bank of Canada keep cutting rates? Let me know what your thoughts are in the comments below. Now, I know for a lot of people, it doesn't feel like it, but if you look at the stats, it says that in December, the national average asking rents in Canada dropped 3.2% year over year, down to $2,109. And this is according to a report by rentals.ca and Urbanation. This also marks a 17-month low. It's the fifth straight month of falling rents. So that's a bit of good news there. The big question is, are these prices truly becoming more affordable, or is this just a temporary pause? Now, when you look at the Urbanation report, President Sean Hildebrand, he says that the rental market softened in 2024 amid multi-decade highs for apartment completions, slowing population inflows, and a weakening economy. So you have to ask whether this mix of factors could signal some longer-term relief for renters, or will prices just rebound again as soon as demand rises? If we look at the various provinces, a little bit deeper dive here, Ontario, which is typically one of the most expensive provinces for renters, they saw the average apartment rents drop by 4.7% year over year 2,332 is the current number there. British Columbia also reported a decrease, but a smaller drop of 0.5%. That brings the average rent there to $2,487. Now, meanwhile, if you look at Manitoba, they kind of stood out here. They had a 5% rent increase, reaching an average of $1,618. That is the highest provincial growth rate in 2024. So with any luck here, this trend will hold and renters may finally see a little bit of relief, especially in those major markets where supply has increased. Now, before I move on to the next story and talk about wine, I did want to say that your financial future is too important to leave to chance. And that is exactly why my son, Brandon, who's really the star of this channel, let's face it, he started the Investing Academy. And this is a company that is dedicated to helping Canadians take control of their investments and build lasting financial security. He got his start investing way back when he was 10 years old. And yes, you did hear that correctly. He then started working at my firm when he was just 20. As for me, I spent 25 years plus as an investment advisor and portfolio manager. I retired, but that didn't last very long. Brandon asked me to join him in his mission to educate Canadians about the stock market. I couldn't resist the chance to share what I had learned with a new generation of investors. Now, together, we have helped over 2,000 investors through the Investing Academy, and this is an online program that's designed to make long-term investing simple and accessible to everyone. So whether you're just getting started or whether you're looking to build on what you already know, we're here to guide you. You can learn more by visiting our website. I will put a link in the description of this video. Now, the last story for today is some good news for Alberta wine lovers because you can now order wine directly from BC wineries. And this is a result of a new agreement that was signed back last summer, but it did launch on January the 6th. It allows Albertans to buy from over 300 wineries through online sales or wine club subscriptions. The agreement is valid for 1 year, then it will be reevaluated and we'll see if it continues after that. This change here is a really big deal for BC's smaller wineries especially, which rely heavily on direct sales. Some quick facts: there are approximately 350 grape wineries in BC. The greatest concentration of those wineries is in the Okanagan-Similkameen region. The BC wine industry generates approximately $3.75 billion annually, contributes more than $440 million in federal and provincial tax revenues. It employs more than 14,000 full-time workers. Now, for every bottle of BC wine that's sold, $105 is contributed to the regional and national economy. The reason this new agreement is so important is that a lot of these wineries don't produce enough volume or have the resources to sell through the provincial liquor boards. They demand larger shipments, bigger products, and they charge pretty steep fees. Now, some hurdles do still remain here. This deal is with Alberta, but Ontario, Quebec, the country's largest markets, don't allow BC wineries to sell directly to consumers in those provinces. And that is frustrating for the smaller producers, and especially since Ontario wineries do have direct access to BC. They've had that for more than a decade here. Also, BC wineries, they're dealing with a pretty steep crop losses from cold snaps, which make it harder to access larger markets, and it makes it more important that they do so as well. Last year, almost 99% of Okanagan's vineyards were wiped out due to the extreme weather that left many wineries still in recovery mode. Temperatures dropped to minus 30 degrees Celsius in the Okanagan January 11th to 15th a year ago, so almost exactly a year ago this week. Now, Val Tate, he is the general manager, winemaker at Gold Hill Winery, and he pretty much sums it all up. Referring to exactly a year ago, he says, "We have no crop this year. I don't know if I'm going to make it. Just 1 to 3% of the usual harvest is expected." So knowing that, it sure would be great if the trial agreement becomes a permanent thing. That is a wrap for today's video. I hope you enjoyed. As always, I really appreciate you watching, and we'll see you in the next video.